Thank you guys for joining us with today's major players, where I bring you a major player in their industry. And I'm really excited today because I have Jayme with me. Jamie's actually my advisor. Anytime I have a question about anything important, I call Jayme. So thank you, Jayme, for joining me today. I really appreciate it. Can you hear me?
No problem, Victor. I've always enjoyed talking to you.
Good, good, good. And I wanted to bring you on because I like to tell people, like, you need to get involved with people who are playing a big game at their level and who knows the game so well that they can
Right.
help you continue to grow. And what I wanted to kind of go over with you, and we talked about it, was like really like what your journey was, like how you actually got your start. So like tell me a little bit about you and how you got started and things like that with what you've done.
Well, it's kind of a kind of a long story, but I'll try to make it as short as possible. Um, I grew up in a little town called Winnie, Texas,
Let's go.
and there's not a lot of opportunities in Winnie, Texas, but I did manage to escape,
Hmm.
and I went to Baylor, graduated from Baylor with an accounting degree. And actually, I went to be a lawyer. I wanted to be a real estate lawyer.
Wow, I didn't know
And
that.
yeah, I know that's kind of crazy, but ended up, I got my CPA, went to work for a CPA firm, a regional firm in Beaumont, Texas. And one of my biggest clients was a developer. And it got to where I was spending about 90% of my billable hours on this one client because they were building condos, they were building hotels, they were building all these things. And what I would do is I would put together their real estate syndication. I'd
Mm,
put together their prospectus to raise money for their investors. I would project the tax consequences of what. Okay, let's say we built this and we sold it in 3 years or 5 years or whatever. I
right.
would do all of the projections.
Okay.
So it got to where I was doing so much for them that I actually went to work for them.
Wow.
And that's how I got into the real estate portion of it.
Okay.
So I I got in with them. I started building. I built three hotels. I built about 900 condo units. I built
Wow.
all these things.
Hmm.
Yeah, it was really, I mean, of course, this was in the last century, like back in the 80s. So, it was wild and woolly, and we thought we would go forever.
Right.
Didn't happen.
Mm,
Uh, the bottom fell out of the oil market, whatever. So
right.
I actually moved. I sold out all of my interest and I moved to Florida.
Oh, wow. Okay.
And I got hooked up with someone that we started building houses.
Hmm.
And then I got hooked up with someone who was buying mortgages. I thought,
Okay.
buying mortgages? What? Okay. Well, I got into that
Mm,
and was just cleaning up. And it just evolved from there.
right.
I became a mortgage banker. I became a lender, a subprime lender.
Right.
And again, just using what we knew that. And one of the things I will tell everybody, push the envelope, but don't ever tear it because that's when you get in trouble.
That's right.
Okay. But push it to the edge.
Yeah.
Just don't ever get outside of it.
Right.
Okay. So we were doing all kinds of weird things. And I actually got to the point where I took my company public in
Mm,
2000. Success Investments, you can look it up, over the counter stock, just again, wheeling and dealing and just, you didn't think it'd ever end.
yeah.
But
Yeah.
guess what? It does.
Yeah, for sure.
But I took my company back private and then sold it. So,
Wow.
I got out of it before all of the big crash.
Yeah.
And so, and I do a lot of consulting.
Right.
I still buy deals for myself. I still do deals.
Yeah. Yeah.
So, and it's fun. It's fun to visualize how you're going to make a deal work
That's right. That's right. And you and I
because
talked
there's
about it.
millions
Right.
of ways to do a deal.
Yeah, yeah, and that's how we met because, like I said, I
Yes,
met you guys through the deals that I did, and you guys actually became a partner of mine and working,
right.
so it's like I always tell people like that's how I got started. My partners had a finance company, they did mortgages, and realistically, instead of from a real estate perspective, because I was finding the deals, when I started coming to the office and working with you guys, like I started learning financial structuring, the engineering, how the debt worked, how mortgages really like the finance side, which very few people get an idea of knowing
Mhm.
what the capital structures look like in real estate. They just think real
Right.
estate. So I had a question for you though, like how was young Jayme? How was little Jayme growing up? Like were you always wanting to be successful? Or was this something that just kind of grew over like, what was
Oh, oh no. I did not want to live in Winnie and be poor. I
There you go. That's a good motivator.
no, I from a very young age, my dad was a rice farmer.
Mm,
He farmed rice and soybeans, raised cattle, the whole bit. And, so my two brothers and I had to work in the rice fields when we were young. You
mm.
know, there, lots of times daddy'd come in, wake you up in the middle of the night. The levee washed out. We got to go shovel levees. Not what I wanted to do.
Yeah. Yeah. I can't
Not
even picture you
anywhere
doing
near what I wanted to
that.
do.
For sure.
Oh
So,
yeah. Oh
so,
yeah. God.
so what was your point? Like, I always feel like everyone has this thing where like there's this moment in time. And was it what you said? You're like, you know what? I was doing all this work and I'd done so much work that just brought me in to the real estate side. But like, what was that moment for you? Was a tipping point to be like, okay, this is it, and I'm going to lean into that.
I think it was when I had been buying and selling mortgages, just
Hmm.
privately held mortgages, buy them at a discount, make money, broker them off. I think it was when in the subprime world,
Right.
you could get what's called yield spread.
Okay.
Okay. And I came up with a way that we could put together a seller finance mortgage
Hmm.
and buy it at the closing table at a discount, say like 92 cents. So take
Yeah.
an 8% discount off the
Right.
top of the mortgage. I would bundle those up with regular mortgages, regular initiated mortgages,
Yeah.
and make them stated loans.
Mm,
Basically, no income, no documentation loans,
right.
and I'd put them in with my other loans, and I'd sell them
Right.
for 107, 110.
Mm,
So I was making 17 to 20 points on every loan, and it was
right.
like, whoa, why am I not doing anything but this?
Yeah. Yeah.
And that kind of morphed into just different ways to
Mm,
put together a deal.
right. Right.
Now, nobody had ever thought about selling seller finance mortgages as newly created.
Right.
So and it was a big deal there for a little while
Hmm.
with other people who were buying and selling mortgages because they're like, you can't do this. You
Hmm.
got to have a license. You got to have a, I'm like, well, I do. I'm a
Yeah.
mortgage broker.
Right.
I'm a mortgage banker.
Right. Right.
Um, I don't, I don't necessarily recommend anybody going out and getting a license
Right.
of any kind.
Yeah. Yeah.
And the reason is it's more personal, I guess, than anything else. But anytime you have a license, you become a target.
Yeah. Yeah.
And if
Definitely.
anything goes wrong with the deal, the first person they're going to come after is the person with the license.
That's right. That's right. Because you're
So
supposed to know better.
if you don't have to have one, if you don't have to have one, don't
Hmm.
get one.
Yeah. Yeah.
So just a little piece of advice.
Yeah. Just do it as an entrepreneur,
So
right? Yeah. That's crazy.
absolutely.
And what's interesting is because you and I have talked about this. It's like when we look at what's going on now, we've talked about it more the financial engineering, right? To creating your own finance product, which is what you did, right? It's no
Hmm.
different from
Right.
an institution or Wall Street coming up with, you know, a financial product, they give it a name, and then they go to market with it, and they become the market maker. Like, hey, we have this new financial instrument, whether it's tied to
Right.
bonds or whatever, right? Which is, I guess, and correct me if I'm wrong, isn't that the same thing as like, so you have a good note that's good, like a secured note, like let's say it's a good note, like we were talking about non-stated, but
Yeah.
this was backed up. That's almost like the bond security part of it. So like it's not going to do less than this piece, and then we have this other piece attached to it, the second that is there. So like worst case scenario, this second and this first that has this bond security is not going to drop less than, let's say, 5%. So this one's at five, this one's at five. If there's an issue with this, with the, so now it's 10. If there's an issue with the, no, let's say this five drops to two. You still have this five that's kind of almost like a stop. I would say they're door stops.
Right.
So I
Right.
notice people are now doing that with their real estate. Like I'm a limited partner in Cardone Capital, and they're doing that with their real estate right now, where they're attaching real estate in a fund also to Bitcoin. So Bitcoin is volatile, but the real estate is buying the Bitcoin. So the Bitcoin would literally have to go to zero, but the bond instrument inside of the fund is the real estate that's stable. So worst case, you're going to get 7%,
Right.
and then you have this big bang on this other instrument tied to it. So I've just, and I could be totally off, but when you were talking, my brain started, that's, you and I were talking like that creative side of finance. I start thinking like, oh, wow, that's a good financial structure. If you can package that and sell it to the market, it'd be bought and people would actually make a lot of money doing it. Right. So that's
Right.
cool.
Well, do you know what do your people know what happens to loans when they are bundled up? I mean, it's once you understand how the market works,
Hmm.
believe it or not, it will help you in your real estate more than you will ever know. You probably don't care that these loans are bundled up and securitized and sold off at for bond in a bond market.
Right.
Um, but it affects everything all the way back down to going in and talking to somebody about buying their property.
It does.
If you know what happens to this stuff, um, it will help you put together the deal because once you know all the different little pieces,
Hmm.
it gels in your in and every time I talk to you, Victor,
Hmm.
we end up, you call me last night and we
Yeah.
talk, oh, I just called to see how you were doing. We talked for 3 hours.
Yeah.
You know,
Yeah.
we feed off of each other,
Hmm.
you know, and if you say something, I'm like, oh man, we could do this, we could take that and do this
Yeah.
with it. So, what you have done here with your major player, what you're doing is you're giving everybody the opportunity to learn from everybody else.
Yeah.
And they might not even know that they know it.
Right. Right.
You know,
Yeah.
you and I sit here and talk, and I'll say something and you'll go off on a tangent. And I'm like, well, I didn't think about that.
Yeah.
You know, feeding off of each other and having you as a resource is unbelievable. Of course, you did learn it from me, but
That's right. I learned it from
you
you.
did go
Seriously.
way beyond me.
Well,
It's,
I mean, that's the
and
beauty
and
of,
where you and I,
go ahead. Go ahead. I didn't want
well,
to
I was going
interrupt
to
you.
say where you and I differ.
Hmm.
No, it's okay. Where you and I differ is I take advantage of distressed properties
Right.
and which is a lot more work. Don't it is a lot more work. You've been
Yeah,
there, you've
I
done it,
have.
I've done it, but it is a tremendous amount of work.
Hmm.
And A paper properties that you're going after, the jewels,
Yeah.
those are no-brainers, man. The
Yep.
people pay. You're
Yeah.
not standing there on their doorstep knocking, going, "Can you give me the rent?"
Yeah. Or
You
some of
know.
it.
So yeah, yeah,
Yeah.
exactly. Um, so on one hand, Yeah, you can make money with distressed properties. I've done it.
Hmm.
It's a pain in the butt.
Yep.
Um, but A class properties, to me, yeah, your cap rates are higher. I mean, are lower.
Yeah.
You have so much more, not necessarily opportunity,
Hmm.
but God, it's safe.
Yeah. Yeah. And not
It's
only
just
that,
safe.
it is. And you and I have talked about it too. Like, there's a level of professionalism that goes into this. So, like, we've talked about it. So, if you get a Class A, Class B property that's less than 10 years old, you have professional management companies if you're buying at scale because it's institutional or group level, right? Group
Right,
meaning like larger syndicator. You know, it's pretty cut and dry, but it's still
right.
sophisticated enough because banks invest in it, life insurance companies invest in it, debt funds invest in it. You got Fannie, Freddie, you have capital allocated towards it. And I'm going to kind of go a little bit because you get it. Now you have a better debt stack. You have a better capital stack. You have your main debt, you have your equity from investors if you're doing a fund or a syndication, and
Mhm.
you can almost tell exactly where you're going to be if you're at a better, all investments have risk. But like you said, from the financial side, because really real estate itself is a financial instrument. It's a vehicle.
Absolutely.
Right. So what I try to explain to everybody, and I learned this from you guys, over time. It's like the money that pension funds, retirement accounts, all of that stuff is going primarily into real estate anyways. Insurance companies, it's called the float, right? So the premiums people pay for years and years and stuff like that, life insurance companies take the float and they reinvest it, right? On the premise that they're going to put it into something that's secure. So a lot of these bigger firms and companies are already investing in the same things that when we take a look at an asset, we have a choice. We go, well, we can get a better quality of asset that has a good capital stack that banks, institutions, pension funds also invest in. We're just doing it as retail investors, or you can continue to invest where you're investing and you can go after the more distressed assets, higher returns, more risk. But if you take a look at who's investing in those,
Much more risk.
yeah, you have a lot less sophisticated
Much
mom and
more
pop
risk.
investors going after those because those are the entrepreneurial side. But from an investor standpoint,
Right.
when you have if you're a doctor or a dentist and you have 20 practices and you have capital sitting, you have choices. Stock market, mutual funds, retirement accounts dealt with your advisors and RIAs and accountants, or you can invest in syndications or funds that are professionally managed, but they have to go into professionally managed deals with less risky deals. Because if
Right.
you're a doctor, you got 20 practices, you're already in a risky business. You have 20 practices with employees, people, taxes, stuff like that. You want to lay your head on the pillow
People.
and rest at night. So, or
People.
yeah, yeah, for sure. Or the stuff that you guys are doing. It's like, okay, well, fine. Then if you're not going to do that, then invest in notes, invest in being a lender, right? Because I mean, you don't
Right.
get you don't always get the tax benefits of being a lender because naturally, it's just debt, right? So you're one lender. How does that work? Because you're my tax advisor. Any tax strategy, I always go to you and be like, hey, how's this work? How would that work if let's say somebody goes like, yeah, I don't want to invest in a fund. Let's say a equity fund, they want to invest in a debt fund, but they want to be the individual that's doing the loan. So it's so short term, 12-month, 6% interest on
Hard
the,
money lender.
yeah, like a hard money lender,
Like a
but
hard
individual.
money lender.
Hmm.
Okay.
So
There
how'd their
are
tax work?
tax advantages. There
Okay.
are tax advantage. There's a lot of tax advantages
Okay.
because what happens is let's say you go and you lend $100,000.
Okay.
Okay. And they're paying you back at $100 a month.
Hmm.
Okay. Let's make it a 3-year loan.
Okay. All
Just
right. Yeah. That's
okay.
good.
All right. So as your profit, you pay taxes
Hmm.
on the interest
Yep.
and the profit that you make on that loan.
Hmm.
All right.
Right.
So you're deferring your profit and paying it in increments rather than all at one time.
Right. Right. So on that situation in your debt, you're not really making profit, right? So let's say I get it because I've done it. We're like, hey, you're just debt. I buy a property and I pay that person 6% on their money. they're only going to get taxed on the money they got, the 6%, right? And that's at
Right.
earned
That's
income or
correct.
ordinary income, which if they're a baller, they're getting
It's
what?
interest income.
Yeah,
Yeah,
yeah. So
interest
so that's
income.
what, 40% if they're a baller, 60%. Is that how that would work? Some of it, depending on how much money they make?
No, 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 no,
No? How would that
no,
work?
no. Well, okay, so you got interest coming in.
Okay.
It's just taxed at ordinary income rates. So if you're at a 15% rate,
Mm-hmm.
it's taxed at 15%.
Mm-hmm.
Okay.
High income earners, well, most high income earners, they're at about 19 or 20, right?
A little bit more than that.
That, yeah,
If it's really a really high income, yes,
yeah.
more than that.
Well, that's what I usually just round it up to 40. I'm like, look, between where you're at, probably if you have a higher income, which, some people do, I'm like, you're probably going to be around 30 to 40%, depending on where you're at. Um,
Uh,
yeah, is that about right?
30, I think 35 is the cap. I
Okay.
think
All right.
35 is the cap.
Yeah. So that's about right.
I haven't seen the new rates yet,
Yeah, I
but
think they're
yeah.
changing them this
Um,
year or something, right?
but yeah, I mean, there are tax advantages to being
Mhm.
a hard money lender besides the fact that you make a lot of money doing it.
Yeah,
You
with
know,
less risk.
I mean, with a lot less risk.
Yeah. Yeah.
Now, if you're going to be a hard money lender, guys, let me give you a little word of warning here.
Hmm.
Do it in your own backyard.
Yes.
Don't do it across the country
Yeah.
because you can't go kick those bricks.
Right.
And if they're and I have an attorney that's got a bunch of money that wants to invest
Mm.
in he wants to be a hard money lender, and I keep telling him, because he's in Austin.
Okay.
I
Yeah.
keep telling him, you got to do it in Austin
Yeah.
because the first time I mean, you go by and look, and you do the same thing a bank would do. You
Yeah.
would go out and you would say, okay, I've lent X amount of money to get the drywall and this and that. Let me go make sure it's there.
Yeah. That's right.
So, do it in your own backyard if you're going to do that.
Yeah, I like to
Okay.
tell my investors too, which is why I tell them just be an equity partner. Have somebody who's going to take that level of attention what you're doing. So like for example, one of the apartment buildings we bought in
Right.
Hawaii, our bank, naturally our banker, I always tell people like your asset is the bank's asset, right? So it's on their asset column
Right.
and you put it on your asset column. Well, how's that work? Which really means that's a liability, right, for them too until you pay it off. And I know we had bought an
Right.
apartment building and we were out, initially I was like, hey, here's what we're gonna do. We're gonna plant palm trees in the front. It's kind of my, our brand. And our banker called maybe about 4 weeks into it. And he was like, hey, how's the palm trees coming? And I was in an event. As a matter of fact, I think I was in an event in Texas at the time, from Hawaii, right? And I was like, yeah, we're getting it done. And he was like, oh yeah, I drove by because I was in the area and I didn't kind of see that going in, so I was just curious to know how it was going. And
Right.
just what it dawned on me, I was like, oh wow, this is why I tell people your bank is your first partner. Like your lenders, your bank, it doesn't matter whether it's a bank or like a institution or a private lender. They are your partners, and it is their
Right.
fiduciary responsibility to protect their investment. So whatever you tell them you're going to do, you need to do it. Which is why I tell
Right.
people like if you're going to invest, don't dabble. Like you said, if you're going to be a lender, don't dabble, and you have to dabble if you're not there. And if you're going to be an investor,
Right.
invest with somebody who's not a dabbler because this is a full-time gig and
Right.
there's people involved. For example, even if I get a deal, like I got property management companies that we work with, Matthew over at Graystar, my securities attorney, I talk to you. They aren't going to have access to a team or want to build a team because at some point in our office, we're going to need a financial department, right? That handles, money coming in, distributions coming in. Like you said, Vic, you need a controller years ago. So it's like there's so many things that people don't understand that this is a business. And if you're in the business of investing,
Oh,
is different from being in the
yeah.
business of investments. Because once you add the MET on there, MENT on invest, an investment is a long-term thing. Investment may be short, but that's more active in my mind. Like, oh, I'm investing. Which is what I love about you. And which brings me to my next thing too, because I worked with RealPage for a while. I used to work at RealPage in their accounting stuff, and I wanted to kind of go over that as it relates to you did accounting, you've helped people raise capital, you've dealt with their deal structure. Like, how is that working with companies like that, as well as having that level of knowledge to also working with like individuals for like consulting and asking questions like this? Like, what's the difference between those two, or are they literally the same thing?
They're not the same thing, not even close.
Yeah.
Um, I actually I use a whole different language when I talk to banks and other investors and
Mm,
everything. It's a total different language. You know, I may be looking at a portfolio from a bank, and first thing I want to know is what's the whack and the wham,
mm.
and an individual investor go,
There was
"What the
that.
heck is that?"
Yeah.
You know, it's the weighted average coupon of that portfolio or the way, you know, that kind of thing. So I use
Right.
a totally different language when I'm dealing with different people.
Right.
Okay.
Right.
Um, eh, dealing with bigger bigger people and yeah, investment companies and this and that and the other, it's fun, but they're sharks.
Hmm.
That's what they're there for, is to
Yeah.
make money.
Yeah.
Um, and you can't go in being a meek, mild, hey, I'm a newbie.
Hmm.
I would like to see what you've got in your portfolio that you want to get rid of. You know, that's like waving a red flag at a bull going, this person doesn't have a clue.
Yeah.
And when they
Yeah.
think you don't have a clue, they think you don't have any money and they're not going to mess with you.
Right. Right.
So that's why it's perfect to line up with someone like you or me
Yeah.
that already have the inroads, that have already created the relationships,
Hmm.
that these people know that you are not a goofball.
Right. Right. And this is something, and thanks for sharing that because I talk to people and then you and I've talked about it. People like talk to me and they're like, "Oh wow, you're actually sharp. You know what you're doing." And I was like,
Yeah,
like you said, because there's different languages at different levels. Like
right,
you said, it's like you're talking about that. People know, it's like being a doctor. Like someone will know you're a doctor based on the language, the descriptions that you use. But they'll know at what level as well. If you say the thorax
right,
versus the throat, they'll be like, okay, he's a doctor or he's just some guy, or gal.
right,
So no, that's interesting
right.
to me. So, you talked about taking the company public and then taking it private. How was that? Like that's interesting to me because at some point I want to do that, or I want to buy a REIT, public REIT, if ever at my lifetime and get big enough, and then kind of do the Sam Zell activity of like buy it and then liquidate some of the assets because the sum's probably more valuable than the whole of those pieces, and then exit those things. How
Right.
was that when you did it?
It was interesting because I did not do it like with an attorney that goes out and do an IPO. I didn't
Mm,
do that. The most cost-effective way to take a company public is to find a clean shell of a
mhm.
company that's already been through their IPO
Right.
and it's just sitting there doing nothing.
Got
Okay.
it.
So it's called a reverse merger.
Right.
And you take those shell, you swap 100% of that stock for a
Hmm.
percentage of the stock in your company. And
Mm,
now because you've done this and you own 100% of the stock in that shell, publicly traded shell company,
yeah.
you can merge your assets into there and become a publicly traded company.
Got it.
It's considerably cheaper.
Hmm.
You know, to do an IPO, you're talking 250,000 dollars.
Yeah.
I know a speaker, Ron,
Yeah.
tried to go public and they didn't even raise enough money
Mm,
to cover their IPO cost.
wow.
So, yeah. Um, and honestly, it also depends on the environment that the economic environment that you're in.
Hmm.
You know, for a long time, everything was so up in the air with this country that nobody wanted to let go of their money.
That's true. Yeah.
And now that it seems to be on the right track.
Yeah,
We'll see.
we'll see.
Uh, People are starting to find places to put their money.
Yeah, yeah,
One of the things you and I talked about a little bit last night was the stock market is going absolutely absurd.
yeah.
Uh, I don't, which from a CPA standpoint, it's not, the stock market is not trading on absolutes. They're not
Yeah,
trading on anything. They're
yeah,
just, it's just wild and woolly and everybody's throwing their money in
yeah,
and
yeah,
it's working.
yeah.
So it's hard to get an investor to say, yeah, I want to make 5% on my money
Right,
when they're
right.
making 20 in the stock market.
Yeah, yeah.
So, but again, the stock market could crash any day,
Hmm.
any day.
Yeah,
You could have all of a sudden a sell-off and there's all your gains gone.
yeah. I mean, that's happened
So
what, every other
is
month?
it,
Yeah.
yeah, yeah. So is it better to put your money in at a low return that's safe, that you know you're going to get?
Hmm.
Or is it better to be speculative and stick it into something that you might lose it all?
Yeah. I know the most people I talk to, I just tell them like it's a long-term game. It's real estate.
Yeah,
They're bigger, more quality real estate. They're steady Eddie. That's really what you want. And if it's not, then by all means, it's okay. But you need to know where you want your money. And if you know
right,
where you want your family's money long term, that's a very different conversation. Like we said,
totally.
investing versus investments, totally different. So you're right about that because even when I'm always thinking like, okay, here's where I am now, but where am I going? Because those Legos need to eventually click together, right?
Right,
So, that's why I'm always curious. I'm like, okay, if we took a look at some point, in order for me to get where we want to go with Bell Capital in the future, I'm probably going to get into needing to buying
yeah,
portfolios, period, end of story, to buy out some fund, you know, um, eventually go to some institution and hopefully have a big enough portfolio where we can either securitize a portfolio somehow. We can go in there and say, hey, can we get a line from like Arbor's Realty or something like that, some bigger firm or some bigger company, and do that on the premise that I can do a balance sheet purchase on a fund where we take down 6,000 to 6,000 units or bring in partnerships. That's my target. Um,
right,
and you've seen that happen because you kind of work on in the CPA entrepreneur space, real estate space over time. So that's really the goal,
right,
which is why I'm always like, okay, Jayme, I'm always trying to ask Jayme, like, hey, here's what I'm doing now. But I always like to leave in the front of anybody's, my mind really, and it's not for other people, it's for me, where you're headed with this and why you're doing it. Because, and you can tell me this, and you've probably seen it. People who build something, their foundation that they buy a bunch of properties only later to find out they got to dump them all because they don't go with their future portfolio. And I've had this experience, which is why I had to stop doing it. I had to kind of really sever ties with the way that I was doing things in the past because that becomes your experience to the banks. They're like, well, you don't have any experience doing these, you know.
right,
Um,
right.
and I lost my thought on my question because I was so excited. But
Well, I've actually picked up properties from REITs.
mm,
um, that they are not just REITs, but other, I call them vulture funds.
yeah, they are.
Uh, they are.
Yeah, VCs.
But if I picked up a hotel in Orlando from a REIT that was just diversifying it from they were getting out of the hotel space
Right.
and they dumped it and at
Mm,
a pretty major discount.
right.
And so, that's another source
Yeah.
of A properties because there's insurance funds, there's REITs, there's all kinds of different funds
Hmm.
that they may just need to diversify. They may have too much of one kind of product
Right.
and they want to diversify. So,
Yeah, yeah. And that's it. That's interesting because I know at some point that's going to be a target of mine's. is taking a look at, because that's easier to see. If it's a publicly traded REIT, there's a list, you can go in and you can go through the securities exchange and you can get a list of all their assets and you can kind of see.
Right,
I know one of my buddies in Hawaii, their company, MW Group, and they did a partnership with Blackstone and they just bought out Alexander and Baldwin and they bought it public and they took it private. It's one of the
right.
largest real estate transactions that Hawaii's ever done. And I actually called the office to find out if there was any apartment buildings that they were interested in in their that portfolio they bought to sell. And there's not. It was primarily like other type of assets. There was no multifamily there. But to your point,
Right.
I knew Steve, so it was easy for me to be like, "Hey, Steve, like, what do you have?" Um, and this goes right back to like the assumption, like when people meet people, you don't know, like they'll meet me, but they haven't met you yet. Or like I met Steve years ago. We have a different relationship, but it's like that's why being a part of we were talking about starting our club, starting a real estate club and being involved, and you don't know what you're going to do. Like if you're going to be a limited partner, you can be involved in deals that you wouldn't have access to being outside of one. Or you can be an active
Absolutely.
person and be involved and say, hey, we may have something. Is this a fit for anybody in this network that would be interested in being involved in it, investment wise or advisory wise? So, because
Right.
advisors, you need advisors on your team. You need to build a board of advisors to show people that you're not a solo player, or at least you're not the solo brain ever. So that's a
Right.
good example. So
Right.
when you brought that up, you made me think about it because I just do stuff. I don't think all the time that that's a play. I'm just trying to get a deal. So, so no, that's super
Yeah,
cool.
you're a deal junkie.
I am, man. I am. I'm trying to put that capital hat on to be like, hey, I'm a money guy, but I'm a deal maker at heart. I just want to, I would like, hey, how can we put
I
a deal
know.
together? And, I always say conventional financing is the new creative financing. Um, Being able to structure a deal with regular financing now, banks, Fannie, Freddie, life insurance companies, and then put together the equity fund. I think equity funds and debt funds are going to be the way to go because at some point we're going to have a debt fund as well. So, man, and I appreciate having you here, but I want to ask this is the last question. What do you think it really takes to be a major player in your space today, nowadays?
To be a major player,
Mm-hmm.
you got to have a mentor.
Mm,
You got to have somebody that's been there, done that, and got the t-shirt.
right,
Because if you learn from them, I did it by the school of hard knocks.
right.
I can't tell you how many mistakes I made, but I guarantee you, a mentor, someone to hold your hand and say, look, I've done this before. You're going to bust your butt if you do this.
Right. Right, man.
So
That's awesome.
I think that I think that the major thing, if I had any advice to give a new investor, is find someone that you know has been successful and let them help you.
Hmm. Hmm. And when
It's
you're
going to
saying new
cost you a
investor,
lot less in the long run.
yeah, yeah. And I want to be clear too. Like when we're talking about new investors, guys, we're talking about, let's say you know, you have money, you have money in savings or investments and you're doing stuff and you want to be like a limited partner in like a deal or whatever. You're going to do your own deals. Like you need people around you. You need a mentor, you need a consultant, you need an advisor. Like this isn't a solo player game. So like
No,
Jamie, like I always tell people, I'm like, are you new to real estate or are you like you're what are you trying to do? I was like, because there's an
right.
education gap that's also missing, right? So like you said, like Jamie is an advisor and she's a good mentor, but there's enough information out there for you to go and learn how to stuff. So do
Oh,
your
yeah.
part first, like because it's one thing to have a good mentor, but it's another thing to be a good mentee. Because if you're just brand new and you don't know anything, no one can mentor you through what you don't know. You got to do your own part, which takes like and I'll do this now. And like so, because when I met you guys, I hopefully was a good mentee because I was so committed. There was all it was like, tell me what to do, and I'm like done. or I educated and I came back and I had I had more educated questions, so you could mentor me. Because like you said,
Right.
do because you've told me a lot of stuff, Victor, don't do that, and I'm like, okay, I ain't gonna do it, right? And then I did it, and then you were right, and I was like, oh, you were right, like, but I had already done the hard work on my
I
own.
hate being right all the time.
No, man, you know what? That's a superpower. Like not wanting to be right and still being right is a superpower. So, but no, I appreciate that, guys. I really do. Like having a mentor, I 1000% agree with that with you. Oh my gosh, 'cause you're a mentor to me. You have been my whole life. So I really love you and I appreciate you for that. So, and still,
I love you too,
for sure, for sure.
or I wouldn't put up with you.
Absolutely. You know what? I agree with that. I was like, you have full responsibility to just like, hey, Vic, no, and get rid of me. So, especially when I don't listen. So, and I appreciate you. All right. So, thank you so much,
No,
guys.
I
Thank you,
do
Jayme,
listen.
for thank you for being here today. I really appreciate you. And
Totally my pleasure. My
perfect,
pleasure.
perfect, perfect.
Okay.
So, all right, for sure. Well, you have a
All
great
right.
day. Everybody that wants to get in contact with Jayme, how would they get in contact with you? Just to ask Jayme?
Ask Jamie at Gmail, but make sure you spell Jamie right.
Okay,
It's
it's J
Jayme,
Got
Jamie.
it. Jayme. Ask Jayme at Gmail. And sh don't waste her time because she's super smart. She's there for you. But like I said, she's there to kind of help you move along. So I appreciate you, Jayme.
Right.
Thank you so much for doing this with me and sharing your experience with people. And we're going
Anytime.
to be doing a lot of stuff together. Okay. All right, guys. Have a great day
All
today.
right. You got it, Victor. Thank you. No, it's like